Hey everyone, it's Daniel here from InfoRest. Hope you're all doing well. Just wanted to do a quick video to discuss about what happened on Wednesday when Jerome Powell came out and to discuss about the policies and the expectations, and most importantly, to kind of give the answer of whether or not we are getting this Fed pivot. Now, how the markets reacted and how it initially started was that we got this statement from the Federal Reserve at 2 p.m. So in the statement at 2 p.m., they did add a line that did say that, okay, they're going to look towards slowing the pace of their rate hikes and not be doing these big, massive 75 rate hikes going forward, right? The speed of it, they definitely are slowing down. And as soon as that statement came out, right at 2 o'clock, the stocks, bonds, gold, currencies all rallied. The dollar sold off right at 2 p.m. But 2:30, Powell came in and basically threw cold water on all of that. And he came in with a very hawkish tone, saying that, hey, yeah, okay, we're slowing down the pace of the rate hike. Doesn't mean we're done. Doesn't mean we're pausing. And the equity markets and the bond markets, the whole markets as a whole, was expecting that, okay, we're probably going to see some sort of pause from the Fed, if not rate cuts for next year. And that was not the case. The Fed came out and explicitly said that we have a job. We have a job to combat inflation. And it's funny because I've been saying this so much in the previous videos. I did a video on this saying that we could see rates go above 5%. Why would it stop below or slightly below 5% if inflation is not being solved and we're not seeing really strong signs of it? And it looks like the Fed is going to go in that direction. And Wednesday's meeting confirmed that, because the Federal Reserve did come out and the Federal Reserve did say that, hey, we're going to go higher for longer. We're still raising rates. And in our forecast, the Fed also came out and said, we may have to adjust our forecast for the rates as well, and the terminal rate. We may see a higher forecast for rates than what we were expecting before, which basically means for December, when they release their forecasts, when they release their dot plot and their projections, you're probably going to see in the projection component of the interest rate that they're projecting next year to probably get to above that 5% level. So maybe between 5 or 5.5 around there in interest rates, or maybe even higher. We'll see what happens, right? But that was pretty hawkish for the Fed to come out and say that we're not done. We still have an inflation to fight off. We need evidence. Just because we're slowing the speed and the pace doesn't mean we're done. The only question to look forward for now is, where do we top out? Where is the end of this? And he came out and said, we don't know yet. We are data dependent. We need to assess the situation. We need to assess inflation and so on. And then we will decide, whether we're stopping, but we're not nearly close to that. Sure, yes, we are slowing down the jumbo rate hikes. That's basically, in other words, what the Fed came out to confirm. But that doesn't mean it's a end to this rate hike cycle. We're still going to see rates continue to move up and up and up. And when you look at the markets react to that at 2:30, stocks, bonds, gold, currencies, all reversed course, sold off, and the dollar went up. The yield curve also continued to deepen in inversion territory and start to invert even more as the market started to price in more rate hikes to come. So even though we're slowing down, doesn't mean that we're done. And, I've also been saying this, that this bond market, the inversion, is something to keep an eye on, because we're not going to get rate cuts until the bond market tells us, until we start seeing that steepening, until we start seeing that rally, until we start to see it being priced in the bond market. And since, a couple of weeks back, the stock market was acting as if we were getting a pivot, but the bond market not so much. And the bond market was right if you were to go back a couple of weeks and just assess how the bond markets were trading in comparison with the equity market. And another thing that I mentioned in my previous video that is also not very shocking to me, and after Wednesday's meeting basically confirms this, and of course, this theory and thesis can change, and definitely, depending on data, this can change and adapt and change over time. But I've been saying this for some time, that in order for inflation to come down to your 2% target, we haven't seen that happen, especially when inflation's elevated, unless we get a recession. So we need some sort of recession. We need pain in the economy to bring that inflation down. And the Federal Reserve knows that. They're just not explicitly saying it to you. There was also comments about the soft landing. They asked Jerome Powell, is the soft landing narrowing now? And he said, yeah, it's still possible, but yes, it has narrowed. Of a potential soft landing has definitely narrowed. So all of these signs, when you put it together, raising rates, yields going up, bonds selling off, definitely continues to put more tightening pressure on the markets. Now, you may argue that other economies out there, when you look at, let's say, Bank of Canada, for Canadians, Bank of Canada raised rates by 50 basis points versus the 75. You look at the ECB and Australia and so on. Everyone is starting to slow down the rate hikes, as well as the Federal Reserve. But the Federal Reserve is still continuing on its path, still continuing to be hawkish. And part of doing that will cause the US dollar to continue to move up. And if the US dollar continues to move up, and if inflation doesn't solve on its own or doesn't go lower, then definitely a higher US dollar is going to create pain for a lot of countries, especially emerging market countries out there. When you look at Sri Lanka, you look at Pakistan, you look at India, China, and so on, a lot of countries out there that are doing business in US dollar, and especially the countries that depend on importing food prices are moving up higher, and you have to pay higher. Not only you have to pay for higher food, but you have to pay in terms of higher currency, because the dollar is moving up. Now, when the dollar starts to move up, it will create pain not only just within the U.S. or the tightenings are not creating pain within the U.S., but the higher dollar will also create pain globally as well. So it's not just the U.S. that is at risk with this tightening. It's the global markets as well. If you see this US dollar continue to rally higher and higher and higher. So if this rally in the US dollar continues, definitely there could be debt bubbles that burst, and it could be a trickle effect. And in the conference, in the meeting, Jerome Powell did mention, and there was a question about the US and the status of the US and how this tightening can affect other countries. And Jerome Powell did come out and mention that US has to do their job to help everybody, to tighten, to bring this inflation down. If you have OPEC Plus cutting production, oil prices like today went up 4%, the supply chain that's still being disrupted, Putin's war that's affecting energy and food prices and so on. And now rumors also, and I did a video on this too, you check it out, on China reopening, which will also bring in demand and spur inflation higher. Then yeah, the US economy, the US is in charge. It is the US dollar is the world reserve currency, and they will have to combat all of those issues that are causing this higher inflation and combat it with the tightening, with the higher US dollar, so that it can create some pain globally to hopefully, eventually bring a demand crunch and bring inflation lower. And again, I'll repeat it again, for inflation to hit that 2% level, especially at where we are right now, we'll need to see a recession. We'll need to see something break, something crack, definitely, for this to come off and to come down. So Wednesday meeting was a confirmation of that. The hawkishness came in. It was kind of a surprise, I guess, for some people who were expecting kind of a dovish Fed, for the Fed to slow down. And we're not getting that. I mentioned this a couple of times. The Fed is very, very, very hard on wanting to fight this inflation. Its credibility is online. It doesn't want to ease up, because even the Fed mentioned in this meeting that, hey, if we ease up and we create a mistake from easing up or pausing, then we will have to come back and fight even harder, and it will bring more pain down the road, and this pain will be longer. So they want to eliminate that by tightening as hard as they can now. That tightening will basically shrink the demand, hopefully bring that inflation to the 2% or close to it, and we will also see unemployment rate skyrocket as more tightening pressures will affect a lot of consumers, a lot of corporations, and you'll see a lot of job losses from it. So let me know what you guys think. Leave a comment below, subscribe, hit the like button as well, the bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.